Hey everybody, welcome back to Chipstock Investor. We're back to talk about
AppLovin and advertising, the best use of AI so far. Yep, the ads that you hate on YouTube, coming to you soon on Netflix. I mean, the world is just prolific with ads. AI gonna make them even more efficient.
in October, we made a video about AppLovin. And at that point, it was up about 1,200% since January 2023. And now it's up 455% year to date. Why is this such a hot stock? Let's talk about that. We'll talk about these 3 points in this video. The best use of AI so far. We'll expand on that digital ads portion of the business. The biggest AI beneficiary is AppLovin. How is that happening? And is there still time to buy AppLovin stock? The economy thrives on the production of goods and services, and that makes up the largest part of the economy by far. Interestingly, AI's primary contribution to date has been further amplifying advertising revenue, building on what the internet has been doing for decades.
And AppLovin has a small part to do with this. Specifically, their platform focuses on in-app advertising, especially mobile gaming.
Before we continue, quick word from the sponsor of today's video, and you probably know them very well because if you watch our videos regularly, you know that we use finchat.io in every episode.
Yeah, finchat.io is a complete stock research platform for fundamental investors. They really have it all. If you like financial data and you like visualizing financial data on not just US stocks, but anywhere in the world, 100,000 stocks globally covered by the finchat.io platform, including company-specific segments and KPIs, key performance indicators.
Like for instance, we're talking about AppLovin today. They have software platform revenue and apps revenue broken down quarter by quarter, year by year, or even in trailing 12 months.
And some of these KPIs get very granular. So within, for example, the apps platform segment of AppLovin, they have listed in their reports in-app purchases versus in-app advertising. We've talked about this in past videos, what those are. You can actually get those visualized right in finchat.io. So you don't have to try to figure out what that actually looks like or try to imagine what it looks like. FinChat's got you covered.
FinChat is completely free to use, but if you do want to upgrade to a paid plan, you can use our link to get 15% off. Link is in the description below and here on the screen, finchat.io/CSI. Back to the episode.
They have these different parts of, for the time being, what's called their software segment. It's actually going to change its name to the advertising segment starting next quarter. But there are 4 core services to this. App Discovery, which helps developers market their apps to prospective users. Max is the ad bidding marketplace where developers can list in-app ad slots for sale. And if you're a marketer, that's where you can purchase that ad slot for your marketing campaign. Adjust is the analytics software part of the business, measure the effectiveness of your ad campaign. And then Whirl was an acquisition a while back for connected TV applications, or CTV is often how you see that stylized. So specifically though, let's talk about the in-app advertising segment here. That's what's driving this really incredible growth for AppLovin. And the reason the market once again rewarded this stock immediately after the earnings release for Q3, the stock was up roughly 30% again.
All of those portions of the business fit under this software segment. Software platform revenue continues to climb. It's reached $835 million in Q3. And on an adjusted EBITDA basis, earnings before interest, tax, depreciation, and amortization, the software biz reached all-time highs at 78%.
78%. That's pretty incredible.
It's awesome.
Yeah, this is the power of AI at work. AppLovin's Axon 2.0 AI algorithms, kind of a black box. Of course, they're not going to talk about the inner workings of that algorithm because there are lots of digital ads companies out there that would love to copy it if they could, but it's clearly working and getting a lot of marketer ad spend as a result. So let's talk about what's driving this a little bit, and as well as AppLovin's expansion into other advertising verticals like e-commerce.
So Nick, let me get this straight, because AppLovin CEO has said that they expect 20 to 30% revenue growth per year for the foreseeable future. He's focusing just on the gaming portion, not this e-commerce portion of the business.
Yeah, that's right. So e-commerce is a new vertical that could further drive growth over and above what they're already generating from primarily in-app gaming revenue, mobile games, mobile video games. Yeah, you're right. E-commerce is new.
And all of this is because of AI, the best use of AI, right?
Yeah, for as long as digital ads have been around, you'd think that the technology has been perfected. But it's interesting. Farugi mentioned in the Q&A section of the earnings call that there's still a lot of work to be done, especially in-app advertising, where user acquisition budgets. So that's when a developer, makes an app, and then they need to somehow figure out how to advertise it in an effective manner to get people to download their app and start monetizing what they've created. So UA, or user acquisition, is a big thing where there's still a lot of work to be done. And they think that they can just extend some of those same AI algorithms into e-commerce now as well, where there's a lot of budget that could be spent that supposedly isn't being spent because the technology still is lacking the proper return on investment metrics that marketers are looking for.
Okay, that makes sense. And let's focus on another smaller portion of the business for AppLovin. This is their app segment. They actually have several popular games in-house by their own developers. And these games are, of course, eating the cooking of the ad software of the parent company, AppLovin.
Yeah, it would seem so. That is the case.
But since the pandemic, when we were all playing a lot of games on our phones all the time, this segment has actually just flattened out. But AppLovin is really focusing on maximizing the profit of this segment. They did take a step back in this. The profit dipped below 20% again in Q3.
Yeah, this is an area where they will continue to try to optimize this, they said. And one thing that we haven't stated before that is worth noting here, really what they're saying by all of this is that this is a non-core segment of the business these days. And if the right buyer were to come along and offers the right price, and I'm sure AppLovin would be interested in baking into the deal these app developers continuing to use the Axon AI software for in-app ads, AppLovin would be interested in selling off this apps segment of the business. So just maybe bear that in mind. Potentially AppLovin may part ways with this at some point in the future for cash.
Let's move on to the second point. AppLovin has been a huge beneficiary of AI. If we shift back to 2022, Google Cloud and AppLovin announced a partnership. As part of the deal, AppLovin committed to doubling down on the use of Google Cloud services in exchange for the support, which was at that time Axon software, the first version of it. And then in 2023, Google Cloud had just purchased and installed a bunch of Nvidia L4 Tensor Core inference GPUs, and AppLovin was going to be one of the first users as it put out its new Axon 2 and got that to work.
Here's a picture of those Nvidia GPUs. And the management team did say on the last call that at this point, with support of Google Cloud, AppLovin seems to be one of the largest, most prolific users of these GPUs at this point in the world. No specific numbers given about how many GPUs they're using, but given the size of the revenue stream of that Axon powered software segment, coming up on really quickly on $1 billion per quarter in revenue, we can infer that a lot of inference is being done by these Nvidia GPUs in Google Cloud.
This gets us to point number 3. Is there still time to buy AppLovin stock? Well, the truth is AppLovin management continues to see a great value in their own stock.
Mm-hmm. Yeah, they repurchased more stock, 437 million worth in Q3, and they did add on another 2 billion in share repurchase authorization. Total authorization back up over $2 billion now with that addition. And here's a key point to this addition. They did say that this round of repurchases will be funded with actual free cash flow, not debt. So this is something that we highlighted in past videos. AppLovin got really aggressive repurchasing their stock because they thought it was dirt cheap. They actually took out over the last year and a half, 2 years, a couple $1 billion worth of debt and plowed it back into repurchasing the stock. They're no longer doing that. So maybe the stock isn't dirt cheap anymore, but they still see obviously a good enough value that they're willing to throw pretty much all of their free cash flow, projected free cash flow at it for the next couple of years, or at least a large portion of their projected free cash flow over the next couple of years.
So what does that mean for us? Or should we be taking out debt to fund our AppLovin stock?
No, we should not. That's not our MO.
On a trailing basis, price to earnings at 70x, which seems a little expensive. But if you look at the valuation on a forward-looking basis, we have the PEG ratio highlighted there. It's 0.28. So looking forward on expectations, it's not too bad.
Yeah, and this is what's really crazy. If you go back by now, hopefully you've probably just seen the earnings release with the earnings per share growth figures. You're not going to get 200, 300, 400% year over year growth for forever, obviously, on earnings per share. This is just a result of the company scaling off of very little profitability on a GAAP basis to a lot of profitability on a GAAP basis. Even so, if we factor in for maybe another couple of quarters of triple digit earnings growth before that kind of levels off to that 20 to 30% long-term projection that management has continued to double down on, you still get a pretty reasonably priced business at this point. This one's tough. We have this tendency to price anchor as investors, and you look at, oh my God, the thing's up 400 or 500% in the last year. It's too late. There's no way I'm touching this. But if you look into the future, and if you believe management's claims, that's the valuation that actually really matters. I don't think we're inclined to go shopping again for this after buying it a few times in the last year. But we're definitely not inclined to say like this is an egregiously overpriced business though either. So I think we're happy to just hold pat with what we have. A pretty wild run here. This started out as a pretty small position and is now a meaningful position of our portfolio. 400 or 500% share price growth in a year will do that.
For a company called AppLovin.
I feel like they need a jingle.
Yeah, cue the Motown music.
Or I was thinking like maybe old school AM, FM, small town business radio jingle. AppLovin.
Yeah, we'll let you decide. We'll let our viewers decide.
Keep a cool head about this one, though, seriously. These stocks like this will exhibit an above average amount of volatility, not just up, but also down at some point. So dollar cost average in small bits or nibble in small amounts, if at all. Be cautious and let the business prove its worth over time.
Thanks for watching this episode of Chipstock Investor. Make sure you sub to the channel and check out our Semiconductor Insider membership. Just $5 a month gets you a whole lot of bennies. Check it out below in our description on Ko-fi. See you all again soon at Chipstock Investor.